Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. And on tonight's program, we have an interesting way of looking at tech stocks. I asked Michael Wayne of Medallion Financial to join us at a webinar earlier this week, and I asked him, what are your 5 favourite tech stocks? He looked at those, and he also looked at a number of other questions that came from the audience, other tech companies that he actually has a view on, some not a strong positive view, some a little bit of a negative view. And they cover companies like TYR, Data, One Technology, Seek, a number of other interesting companies, including Audinate. These are all the companies that he looks at, and you might be interested to hear what he has to say about these companies going forward. Then we have Wong looking at what his best investments are right now, and then Gair of Rate Money looks at the outlook for the property market. That's the show. So let's kick off now with Michael Wayne from Medallion Financial. Earlier this week, Maureen Jordan and myself had a webinar with Michael Wayne of Medallion Financial, and he was asked a number of questions around tech stocks, particularly the tech stocks he really likes and some of the others that the people in the group asked him questions about.
I've never asked you this before, but what are your top 3 or top 5 tech stocks?
Yeah, I'll go to the 5. So basically, there's companies like Audinate, which we've discussed, I think, a few times over the last 12 months. That's a business that we like a lot. It basically has a protocol which allows different pieces of electronic communicate to communicate with each other without the need for cords. It's basically embedded in 80 or 85% of all new electronics coming to market. So that's all your big brands like Yamaha, Bosch, all those.
So it's so world significant. They all have put their
basically, yeah, because it's a protocol. It's basically a little piece of technology that allows all these pieces to communicate, and it's so superior to the previous technology that.
Well, Bluetooth.
Bluetooth was an example where that was more of a cooperative and was nowhere near as powerful, but it's also enables large pieces of electronics that you would see at, say, a football stadium or a concert to communicate with each other. So that's one. Another one that we quite like is Altium, and we've liked this one for many, many years. Went through a bit of a consolidation phase, but it had a very good update recently in August. They've transitioned their business model to more of a SaaS model, whereas in the past it was more of a one-off licensing fee. So that's a company that reported very well, held up and performed really well again just today, for example. So there's a bit of positivity in the market for that. Some old favorites such as realestate.com, Seek, if you can classify them as tech businesses. They are a bit more mature, but these are the sort of companies that we think, although they've come back a long way, will in time recover very quickly because they're doing a lot of good things. They've got very profitable businesses and they'll be able to fund their growth internally, as we discussed earlier. And then finally, one like ProMedicus, which is a bit of a hybrid tech and healthcare name involved in diagnostic imaging. That's another business that we like a lot in the tech space and still hold for clients. And any of those 5, we would be comfortable in picking up on a long-term time horizon, but do tier your investment stages. So say you're anticipating you'll buy 50K's worth, maybe do 15K now, 15K in a couple of months, and 15K in a couple of months.
Is that because you think there could be, say, a 5% fall in the market?
I think that's definitely possible. If you look, I mean, I saw a great chart from Goldman Sachs the other day, and basically it looks at when markets tend to recover. So we haven't really seen corporate earnings taper off just yet. Looking at the reporting season just passed, it was backward looking for 12 months, and the last 12 months were pretty good for most companies. But we're slowly starting to see earnings roll over. The analysts' expectations are that earnings will fall away, and I think for each month for the last 3 months, earnings expectations have been decreasing. So you have to wait for earnings start to come off before markets bottom. But if you wait for earnings to bottom, you'll miss the pickup in markets, because markets are forward looking, and once they anticipate we're going to see the bottom in earnings, they'll start to rally. So I think it's definitely possible. It's impossible to pick the market, let's face it, but we wouldn't be surprised, let's put it that way, if we see a bit further downside before things get better. There's just a lot of negativity around at the moment, and we haven't really seen corporate earnings come off the boil. We don't hold Tyro. We never have, but it's one that's always been on the radar because it has been such a great emerging tech name for so long. They were there for a while, very reliant on, they was basically looking to shift their business model away from small to medium-sized businesses where they've done very, very well to try and get some larger clients on board, which is fine, but it's obviously lower margins.
Was that through their health play?
That was their health play. They also had issues in COVID because of their focus. They have a lot in the hospitality industry, for instance.
Yeah.
And then, so we saw that shut down. But the board is very good. There was obviously a takeover offer recently, which was very opportunistic.
You thought it was too low?
I think so. It's hard to say sometimes with Mark Cannon-Brookes whether he's being opportunistic or garnering the headlines, those sorts of things. But there's definitely interest involved in the business. And I think at these prices, that's always a good sign that there's more upside once things improve, is when people are trying to be bottom feeders and pick up these quality names.
And private equity never ever give away anything free to that. So their first offer is never going to be.
Well, he's been, I think one of his first investments was Tyro, Cannon-Brookes. So he obviously saw something in the company initially, and he sees something in the company now.
You got 13%, is it?
Yeah, I kind of know the exact number.
That number.
But I must admit, I haven't looked into the business too much in recent months. So I'll have to probably come back to you with a bit more meat on the bone for that one. But it's definitely an interesting business which has come back a long way. So
what are the history of takeover offers? Like, very seldom is the first one the last, is it?
Well, definitely, absolutely. It also brings other people out of the woodwork as well, people that are interested in the business. They have to get ahead of the curve before it is acquired. But I don't think that will be the last of it, especially if the price stays low for an extended period. So Appen was one of those wax stocks that everyone was loving for so long.
Did you ever love it?
We did hold it there for a while and did quite well, but we sold out well before it got to $30 and we looked like idiots. But now it's come back such a long way. Our problem with Appen was always that although it gets categorized as a tech business, it is quite labor intensive. So you've got thousands of people in a room, and if you think about, say,
in a room or in rooms all over
rooms around the world. So if you think about a driverless vehicle, for instance, they need to program the car to identify stop signs. So you'll have thousands of people in rooms around the world basically identifying off different images. This is a stop sign, so that eventually there's enough data for the computer to make a decision. So they were performing a function which saved a lot of those large companies that you mentioned a lot of time, and that they didn't need to take on the resources themselves. Appen almost became too big for its boots in many ways, and the large companies such as Meta, such as Google, basically became overly reliant on them and decided that they've become too big. We're spending too much money on these processes. Now we can bring it in-house and do it ourselves. So we would be very cautious of Appen. I mean, every company has a price ultimately, but they've probably had 5, 6 or 7 downgrades in a row now. It's been a long time since they've been able to meet a forecast number, and that's never a good sign. It does show that there's a lot going on in the business, so much so that not even management is able to predict the future with any clarity. So they're obviously losing contracts, not winning contracts that they once would have won. So that's a business that we would be steering clear of.
Is it also the case of Appen? I was thinking about Appen when I was navigating around the roads of the Peloponnese. And seriously, I was, because my mate, who's a Greek, he was the driver, the designated driver, and I was the alleged great navigator. But we relied on Cheryl from Google Maps. Well, that's the name I gave her because she had a very Aussie accent. But what staggered me was we could go from one Greek village to another Greek village over a course of, say, 45 kilometres, and she would not only get us there in the shortest amount of time, but she would pronounce all these Greek names, maybe like an Australian. But it was just, how could all that information have got into Google Maps?
Yes.
And I figure it must have been done labour intensively
you'll be surprised at still how labor intensive most of these things are and how reliant on people they are. Often when you get those security questions to test whether you're a robot when you're doing a bank transfer, you have to just label this is a traffic light or this is a car. That's often you doing the job on behalf of whoever's collecting that data.
And I often get caught out whether the letter is a capital or a lowercase, and sometimes they think I'm a robot. So I get it wrong.
It's complicated, but it just
But the point I thought was when I was listening to you there is that probably, given the fact that they've got all the streets and all the villages and towns and cities in Greece already done, they don't need to do many changes to get more information to improve on it. It's already in the system.
And that's how a lot of these AI companies work and machine learning. Once you've got enough of a base load of data and that machine's up and running for long enough, it starts to become self-learning. So that's something to consider as well. But the whole thing with Appen, when you've had a market pullback of this magnitude and you've had so many high quality businesses that are still performing very well and growing very well, which are back 30, 40, 50%, do you really need to look at Appen, a business that has been struggling? Because I think you can still get a very good return on the recovery of some of these other names with a lot more certainty in that the business is traveling in the right direction. Yes, so Dicker Data, again, this has been around for a long period of time. This has been an amazing business.
He's a very unusual guy.
Unusual fellow, Mr. Dicker. We've never invested in it and I haven't really looked at it for some time, but the thing that's always worried me with Dicker Data is it's a very low margin business. It is selling a lot of hardware and it has got a lot of contracts with these companies which it needs to maintain in order to maintain that growth. So it always worries me whatever happened if they did lose a contract, what happened if they ever had that margin come under pressure even more, because it doesn't take much to go wrong to see that get wiped out. But I must admit, I haven't looked at it in the last 6 months or so in terms of the actual daily goings on of the business. So I probably should revert back with more info. Technology One is one that we have for clients and have held for a long time in some cases. We haven't actually bought much of it in a while. But again, this is a tech business, which is actually a mature tech business in this country. They often build all these different processes and build all this different software for companies. And once it's built, it's very, very sticky product. They've got a lot of contracts in the military and in the government as well. They've had a few issues in the past, which are now resolved, I think up in Queensland with some of the councils and some of the work they were doing there. But that's a business, when you look at the balance sheet, its fundamentals are impeccable. It's had like 10 years in a row of earnings growth and revenue growth. Its margins have been very constant through that period. They've got a very high return on equity, no debt. So this is an example of a mature tech business. So when you do get a sizable pullback, whenever that comes, it's definitely one that should pop up.
If you bought it on all those sell-offs over the last 10 years, you have done very well.
But its growth numbers aren't as attractive as they once were, as the company has matured. I think they played around with their pricing structure as well there a while back, which is starting to pay dividends for them, because they did restructure their business. They might have even sold off or shut down one of their poorer performing divisions. So look, it's again a high quality tech name, but probably no rush to jump in and buy it at the moment. Yeah, so lithium is one of these long-term macro themes that makes a lot of sense. For instance, in Europe, I think about 7% of all new cars are electric at the moment, maybe 8% now. They're looking to get that up to 70% by 2030. So that's already only 8 years away. So there's a lot of demand that's going to be inbuilt into the system. They're also looking to build up their storage capacity using batteries. So the annual compounded growth in demand for lithium is meant to be about 18% per annum for the next 8 years or so. So it's all now, the demand's definitely going to be there. It's just a question of the supply story.
What have you picked up? Because Paul often says that. So it's not hard for supply to catch up. And lithium is apparently not in short supply, it just wasn't demanded. It's
not, look, it's in the ground. The only lag factor really is just building the mines. And we've seen a lot of supply come online in recent years, and there's going to be a lot more to come on. Even the two main ones on the Aussie market, Pilbara and Alkene, although they're in production at the moment, producing a lot of lithium and capitalizing on the very high prices, they're expected to ramp up production exceptionally in the next 3 to 5 years. And they're not alone. There's companies all around the world doing likewise. Depends on what side of the fence you're on. So you've got on one hand Goldman Sachs, who thinks that supply is going to catch up in the next couple of years, and then all of a sudden there's going to be excess supply in the market, putting downward pressure on prices, so supply glut. Then you recently had Macquarie, which came out probably a month and a half ago, who suggested that there's going to be a supply deficit. So it's a very vexed question.
It does depend on the take up of EVs, and I think the take up's going to be bigger than we expect.
Well, there's so many government subsidies in France and other countries in Europe, like they're quite massive.
Yeah,
so for a purchaser, it's relatively cheap to buy an EV.
Yeah, and there's going to be more and more emphasis on doing so. So we actually hold AKE and PLS for clients. Again, you've got to be pretty malleable with your position in these because they can move very quickly. You saw a false dawn a couple of years ago for lithium when the likes of Galaxy and PLS took off, only for the share prices to come back with a thud once there was a huge amount of supply hitting the markets. But prices are up 400% or something in the last 12 months for lithium. So you do have to watch it pretty closely. But I think at the moment, the market's pretty mixed. So you got 50% on one side of the fence on the side of Goldman's and 50% on the side of Macquarie, saying that there's going to be a supply shortage. Eventually, one side's going to have to rush to the other side of the boat, and you get a pretty violent reaction either way, depending on who's right. There's China sits in all of this as well. They've got a lot of lithium, which hasn't really been hitting the market. They've got an inferior quality lithium. A lot of it's been kept internally for them to use themselves. So Goldman's argument is if there is a release of lithium coming out of China, an increase in supply coming out of China, that could shift the market and balance. But we are cautiously optimistic on the long-term outlook for lithium. Whether or not, back to the second part of your question versus tech, it's hard to say. Obviously, lithium's had a very good run in recent times, and the lithium index has done incredibly well, whilst tech's done very poorly. I wouldn't be surprised if you're looking at a pairs trade, if in the next couple of years, tech caught up some of that and maybe lithium came back. But I think there's more value at the moment looking at tech than there is lithium, just given the enormous price rallies that we've seen.
But you have to wait.
But you have to wait.
Joining me now is ST Wong from Prime Value. And it's interesting to see how a fund manager is looking at the market right now. Good to see you, mate.
Hi, Pete.
What do you reckon, mate? Do you think we're close to the low?
It's a really challenging question. A lot of information has come through in the last week or so, even from overnight. So a lot of mixed signals. From my perspective, definitely looking or re-looking at stocks which have, somewhat created, looking perhaps to nibble. I'm probably not at a stage where I'm about to pivot risk on, so to speak, if that's what you're asking me. But certainly from a valuation perspective, companies are starting to look quite interesting from a number of angles. And as I look through the screens this morning, there are a number of companies which I got to say can look pretty attractive for the longer term.
Yeah, well, I'm going to ask you about those in 1 minute, but do you think that October 13 US CPI meeting could be could make or break the stock market?
Wow, that's interesting. At the moment, and really for the past 6 months, it's really been about the macro, right? And getting that macro right has been so important for guys like us from a performance perspective. What I would say is that from the Fed meeting, the Fed decision last week, I think the market's probably factored in quite a fair bit. Look, the headline CPI numbers will stay high. I think that's consensus, or that's what the market would expect. It has a prospect of coming off quite quickly on a headline number, and that's because oil price drives the CPI quite a fair bit, and it's come off a fair bit. But I think the position I'm taking is that the core CPI, which is what the Fed kind of looks at, is still going to be reasonably high. And I think that, and as a result, I think the market is probably, quite right to suggest that inflation in the US at least remains quite stubborn, and interest rates should remain high. I think the silver lining to all this is that with what's happened in the last, 5 or 6 trading days, the market has readjusted interest rate expectations, and it's probably somewhat closer to what the numbers are going to suggest inflation is going to be in the next couple of months. So I'd say, a lot of news has come through where interest rates or inflation at least is concerned.
Let's talk about the companies that you think look interesting. I always love the way you say that. So a company looks interesting. And when you nominate them, tell my viewers how long you expect to wait to get some interesting returns. Let's start with your first one.
Absolutely. On the spot here. Look, from how we invest is that we try to look out for on a 3-year horizon. But that 3-year timeline shifts quite significantly. If you ask the same question and the sort of things I looked for 12 months ago, it was quite different to what sort of elements I'll be looking for in the current environment, even though looking out 3 years. So to give you a checklist, perhaps, Pete, and to your audience, if we look out into companies on a 3-year basis and why we call them interesting, is that a checklist really encompasses 3 simple matters. 1, industry or market structure, and I'll talk to some of the stocks to demonstrate that shortly. So market structure or market position is important because in today's inflationary environment, you want companies to be able to exercise market power to price better, to regain the cost of inflation of doing business. The second checklist I kind of look at in today's environment, looking out next couple of years, is really cash flow. At the end of the day, we're pretty much, balance sheet or cash flow analysts. So we look through the numbers quite closely, and the stronger the cash flows, in my opinion, the better position these companies are. And again, we can talk through some companies which meet this criteria. And third aspect, Pete, and this is somewhat more recent, is that in a market where it's choppy and it's a bit more uncertainty, dividends count for a bigger weighting in how I look at companies or returns. So the better the dividend payer it is, my sense is that I'm going to get a better return over the medium to long term in the current environment.
Yep.
So these are my current 3 checklists.
Okay, so start giving us some names. You've given us an education. Now we want to make some money.
Sure. I think what's happened again last week or so in telco industry has been very interesting, and Telstra fits the bill of these 3 checklists that I just talked about. We all know Optus is in a bit of strife where its data information flow is concerned. It does raises the issue of reputational damage for Optus in the long run. Maybe not next couple of months, but certainly in the long run, companies like Telstra, which is already an incumbent and major player in the market, and perhaps even TPG or Vodafone, is really well positioned to perhaps take market share, at least amongst retailers and consumers, and expanding that into corporates where information is sensitive. So this is a company, Telstra, well positioned, but potentially looking to exercise its market power to gain more market share. And what we do know as well is that our bills, our mobile phone bills, they're not coming down. The average revenue per user is actually going up for Telstra, and that's positive from an industry structure perspective. The second aspect I talked about, Pete, is balance sheet or cash flows. And again, when we look through a company like Telstra, very strong cash flows, and that's why the final point kind of hits home the whole aspect. Dividends for Telstra, it's going to remain quite robust. And if I were looking at somewhat of a choppier market next 12 months, say, I'd have the comfort of returns from dividends, and that really matches what I'm looking for in the current environment as I sit here, looking at different signals of market. So strong market position, potentially getting stronger, ability to price, and we can see the consequence in very strong cash flows. And finally, as a shareholder, I'm getting a consistent dividend, 4, 5, 6% yield, almost better than what you can get from term deposits from the banks themselves.
Yeah.
So Telstra is clearly one, which
Okay.
makes a lot of sense.
Go for your second one now. I'll keep
Second
milking
one
you.
is probably, I'll rank it through large companies, mid-cap companies, and small companies.
Okay.
The second one I'm going to suggest to you, Pete, and to your audience is a company called Event. Let me get the name right.
Event Hospitality,
The
isn't
ticker
it?
code EVT. Yeah, absolutely. So I'm just going to check my list to make sure I got it right. Event Hospitality and Entertainment.
Yeah.
It basically owns, resorts in Treadbow and a number of hotels or hospitality assets across the eastern seaboard with the brands such as QT and Regis, for example. So that's another company where I think is looking quite prospective from a small cap end of town, especially with the sell down in the marketplace. Now this stock is still trading quite poorly because it is re-emerging from COVID. As we know, we are locked down. But what we do know is that hospitality or expenditure on tourism is actually rising, and I think a company like EVT or Event Hospitality and Entertainment is quite poised to benefit. If I visit Sydney, Pete, up in Sydney, if I book a hotel room, say at a Sofitel, maybe not a Sofitel, but say the Fullerton, you're paying like $400 or $500 a night, and that's massive. So it is an industry where the cost of per room or per unit is actually rising much quicker than in the cost of inflation or wages in the case of EVT. So margins should be expanding, and we're going to get dividend not as attractive as Telstra, but still a decent 3.5% to 4% next 12 to 24 months. So EVT is probably another company which looks quite interesting from where we sit.
And what's interesting is that before COVID, the dividend was much bigger. But as you pointed out, a lot of people haven't been going to cinemas. There was a duration where people weren't going on holidays. But I think over time, we'll probably see that dividend grow. Okay, what's your third and final?
Let me suggest put forward Charter Hall. Ticket code is CHC. It is a REIT. Now, REIT has been one of the poorest performers in the market pretty much for the last 12 months. And as we know, REITs trade somewhat inversely to interest rates. Interest rates have been going up quite significantly, and REITs been coming off where share price is concerned. And Charter Hall are one of the many REITs have been sold off in the especially in the last 6 months. But this is a company where, from a funds management perspective, it introduces properties in the market, and you and I can invest in some of their funds or property funds for return, and they obviously get a clip of the fund management fee. So this is one where the REIT sector is concerned, especially when we think maybe interest rates are probably towards the end of its tightening cycle. I mean, it might be another 100 basis points to go, but it's going to increase another 400 basis points. So REITs are probably quite poised as an opportunity in the longer run. Again, looking at a 3-year scenario where valuation is concerned, and from the last reporting period, which is just the August past reporting season, the company is still doing really well. And what we mean by that is that demand for property across its assets are still strong. Vacancies are actually still quite low, and rentals are still reasonably high. But most importantly, the funds management business is really still going really well. So I suggest companies such as Charter Hall is looking quite prospective on a 3-year basis. Maybe tactically in the short term, it still remain under some pressure, depending on where interest rates go, but still on a 3-year perspective. And that looks really interesting from my perspective. Peter, as a bonus, I'm going to throw in another sector which really, which I'm really excited about, which is a sector which I call toll booth companies. Not the likes of Transurban, where you pay a toll to use its highways or roads, but the number of toll booth companies in Australia, which I think your audience should be aware of and really should take into account of. So these are companies such as insurance brokers, AUB Holdings, Steadfast, the tickers being AUB and SDF. So these are sort of companies which will do well in any or most economic environments, and all they do is pretty much take a clip on a ticket. As we buy insurance premiums, they will get a clip on a ticket. And another toll booth company which sort of operates similarly is IPH Limited. The code is ticker is IPH. It is the largest legal IP legal firm in Australia with a sizable operations in Singapore, growing into China as well. It is another toll booth company which will benefit or work through any or most economic environments. And the best thing is in all this, Pete, is that IPH bills most or a number of its customers or clients in US dollars. So a lot of its earnings come from US dollar earnings, which we know has been rising in global markets. So a company such as IPH Limited will actually be a beneficiary of the macro environment, in this case, the currency. So with that, toll booth companies has done well for us from a portfolio perspective, and I think this will be a sector which should continue to do well in the current market environment. So with that, Pete, a number of companies for you to consider and for your audience to think about as well.
Yeah, and you call them toll booth companies because they, like when you pay when you go through a toll, it's the clip of ticket. Yeah.
Absolutely, yeah.
That's
all they do.
Yeah. You're far more creative than I thought you were. Well done, mate. You've really come on over the years. Thanks very much.
Awesome.
Thanks for joining us. That's ST Wong from Prime Value. Well, I always like to try and get a snapshot of what's going on in the housing market from people who are actually operating at the coalface. And one guy who is Ryan Gair, the founder of Rate Money. Ryan, thanks for joining us.
Thanks for having me, Peter. I appreciate it.
Okay. Ryan, what do you think is going to happen with the cash rate for the rest of the year? It's your best guess, but you're in the mortgage broking industry and whatever. What's your best guess?
Yes, I have a bright outlook on interest rates now. Firstly, we've seen, obviously, the RBA have really pulled the trigger quite firmly over the last 3 or 4 interest rates, going up 0.5% on each on month. I'm going to be optimistic and hope that this was the last interest rate rise of 0.5% for this year. I'm actually going to go one step further and hope that we actually, or the RBA actually decides to put rates on hold. I think obviously inflation is a main concern. However, I don't think we need to kill the economy either coming into Christmas time. So my perception on this is they might even hold interest rates until early next year. I don't think that we have hit the ceiling yet on interest rate rises. I do believe, though, we have hit the ceiling on 0.5% interest rate rises. So I think early next year, I'm looking on a bright outlook, is rates will go again, but only 0.25% now moving forward, and maybe only 1 or 2 more before they actually decide to cool it off and stop increasing interest rates.
Okay. Let's use the demand for loans as a forward indicator of what's going to happen in the housing sector. What is the demand for new loans? I suspect refinancing is a big demand for refinancing now, but
yes,
new loans are a good indication of whether people want to buy houses. Is the demand for new home loans coming off the boil?
For new purchases, they have come off the boil. Obviously, last month was record interest in refinances.
Yeah.
People are still buying. Now, the interesting thing is everyone has a short memory as well, Peter. So pre-COVID, these were the interest rates that people were buying property at. It's only 2.5 years ago or 3 years ago that this was the norm. The problem was in such a short space of time with free funding for the banks and lenders and those sorts of things, or very minimal interest rates given out from the government, is where the banks were, of course, and the lenders were delivering all-time lows on interest rates out to the consumer. However, prior to that, and that's only 3 years ago, these were the interest rates that customers were paying, right? So I see it as a bit of a media bang up. There's no doubt about that, because prior to this, people were paying their mortgages. People were still being able to go out for dinner and all those sorts of things. So I don't see the doom and gloom that we're going to be coming into a recession or the whole property market's going to crash by 30%. Obviously, there will be a cool because that's what they're trying to do. But as we move into spring, and year on year, I've been doing this now for 20 years. Spring, there's always a bounce in everybody's step. They start to look at different options. If that's investing, of course, continuing to refinance, and those sorts of things. The interesting thing will be is how spending goes with people in redraw. Obviously, a lot of customers out there still have money in redraw. With low interest rates, they're able to save some money as well. The interesting thing will be for us is to see how that spending goes over Christmas, which will more than likely put an effect on what the RBA does with interest rates early next year as well.
Okay. What's been the demand from, say, new borrowers because they've overborrowed and they want to refinance to try and make their repayments more tolerable? Are you seeing a bit of that?
Yeah, we haven't seen any real mortgage stress yet, so to speak. However, when the media is talking about and everything's out there about interest rates and you should be saving and how you can save and those sorts of things, obviously the refinance market is very hot at the moment. It's very competitive still. Interest rates are still quite cheap overall on historically as well. However, with interest rates going up, and they have gone up month on month on month, every mum and dad out there is looking to try and save a few dollars each month as well. So the inquiry level on refinances for us as well, and just throughout the industry, is certainly at an all-time high compared to last year. Of course, there was a lot of people who were investing in property as well.
Okay, final question, mate. Given what you're seeing in terms of interest in new loans, the mortgage stress levels you are seeing, do you suspect then, and you kind of alluded to it, that these calls of 25 and 30% falls in house prices will end up being an exaggeration?
As a generalisation, absolutely. There will be certain areas without a doubt where suburbs, they have overstretched themselves, and that's always the case. But if you look at it holistically as a even kill throughout Australia, I really don't see it, especially in your metro sorts of areas and whatever else. I really don't see property prices dropping, 25 or 30%. I think there will be a level out, as I've said before, around about 10%. And that's what, of course, they're wanting to do. But no, I don't think there's going to be people who have bought their property and now it's not worth what it was 12 months ago, 18 months ago, 5 years ago.
Yeah. One last quick one. I did a story today on the rental crisis, the lack of supply of properties with immigrants coming in and foreign students coming back. Are you starting to see a lot more interest from investors to buy property, which they ultimately will rent out?
Yeah, and I do think this now coming into spring as the investors come out and the weather, I know it's crazy. It seems to pull everybody out of the winter doldrums, so to speak. And obviously with rental prices surging, that also comes out with savvy investors knowing that they can snap up a good bargain and also as well get a really good rental return, which effectively can sometimes neutralize that mortgage where you don't really have to tip in that much at the end of each month out of your own pocket.
Great
So
stuff.
without a doubt.
All right, Ryan, thanks for joining us, mate.
Thanks, Peter. Take care.
Yeah. That's Ryan Gair of Rate Money. Thanks for joining us, and don't forget it's a public holiday on Monday, so we won't be doing the show, but we will have a blockbuster of a show next Thursday. Thanks for joining us, and don't forget, go to switzerreport.com.au if you want more information about stocks you might want to sell or buy. Thanks for joining us.